Okay, so let's unpack this. We are diving deep into peer-to-peer lending, P2P. It started as this hopeful, almost altruistic concept, but it quickly became a massive global financial engine.
It really did.
Our mission today is to give you the shortcut to understanding this model. We're going to trace its explosive evolution, from just connecting individuals online to becoming this sophisticated data-driven system dominated by institutional money.
It's arguably the single most important innovation in consumer credit since, the credit card?
I think so.
At its core, P2P lending is really about disintermediation. It's a mechanism that uses these digital platforms to directly connect borrowers who need capital with lenders looking for returns.
And it completely bypasses the massive overhead of traditional banks.
Completely.
That why is so crucial. P2P really emerged right around the 2008 financial crisis when banks tightened their belts, and getting a personal loan or small business financing, it just got so slow and bureaucratic.
And P2P offered speed and, potentially better rates for both sides.
Exactly. For the borrower, it was faster access to credit. For the lender, it was a totally new asset class, offering returns that were, frankly, much higher than standard savings or bonds.
That's right. And we've compiled the sources you provided to analyze how this model adapted, and I think most importantly, how technology became the absolute foundation for risk assessment.
Let's start with the basics then. If I'm a borrower, what's actually happening after I hit submit on one of these platforms?
Okay, so the underlying process is almost fully automated. You apply via a website or an app, and immediately machine learning models start evaluating your creditworthiness.
And they're not just pulling one score.
No, they synthesize just enormous amounts of data.
And the platform's job is to translate all of that risk assessment into a simple rate.
Precisely. The platform assigns a risk grade, like an A, B, C, D, and a corresponding interest rate that's designed to compensate the investor for that specific level of risk.
And once it's funded, the platform handles everything.
Everything. They handle all the servicing, collecting the payments, distributing the principal and interest back to the lenders, the whole thing.
But the platforms aren't banks. So how do they actually make their money, given they aren't holding these loans on their own books?
Well, their business model is a high-volume, low-margin service model. They earn revenue mainly through three streams. First, you've got origination fees, which the borrower pays when the loan is issued.
Go.
Second, servicing fees for managing the loan throughout its life. And third, and this is increasingly common, investor management charges, especially when they're dealing with these large institutional pools of capital.
So the key takeaway here is that for a platform to succeed, it's all about operational excellence.
100%. They need incredibly accurate risk models to keep default rates low. They need highly scalable tech to handle millions of transactions, and crucially, strong collections processes.
Because if they fail to collect, the money walks away.
The capital providers walk away, and the platform is finished.
This brings us to the first major evolution of the industry, which I think is essential for understanding P2P today. It started as pure P2P individuals funding individuals, but our sources clearly show that institutional investors completely changed the game.
They did. It transitioned to what we now call marketplace lending.
What's the fundamental difference there?
It's the source of the capital. It all comes down to the money. Pure P2P relied on aggregating thousands of small retail investors.
The problem with that being scalability
Yeah,
and stability.
that's it. When the economy got rough, those retail investors got spooked, they pulled their capital out, and the platform's funding just dried up instantly.
Right. Retail investors are fickle. Institutional investors are stable. And they demand high volume.
Correct. Marketplace lending is defined by the entrance of massive capital sources. We're talking pension funds, hedge funds, asset managers.
And they don't want to fund a $100 loan.
No, they want to fund $100 million portfolios. They provide the stability and the liquidity to keep loan origination running smoothly, no matter what consumer sentiment is doing. The platform just becomes the intermediary.
And this is where it gets really interesting. And let's just segue into the tech. That shift, it couldn't have happened if the platforms weren't just fundamentally better at assessing risk than the traditional banks were.
Absolutely. This was a total revolution in credit scoring.
A revolution.
Yeah, traditional scoring like the FICO model, it relies so heavily on historical data. Did you pay your mortgage? Did you use your credit card? That was the bottleneck, especially for, younger borrowers or people new to a country, the famous thin credit file problem.
So what types of data are these modern models consuming now? How is AI changing the game?
The models are a hybrid. I mean, yes, they still use traditional bureau data, income verification, all of that. But the new competitive edge comes from what we call alternative data.
Okay.
And that data is processed by machine learning algorithms that can analyze all these nonlinear relationships.
Give us some examples of that non-traditional data. What are we talking about?
We're talking about behavioral indicators, employment stability based on, non-traditional documents, analysis of income flows, spending patterns, utility payments, even your digital interactions.
And the algorithm doesn't just read the data.
No, it learns the weight of each variable. So for a freelancer, say, the stability of their bank deposits might be weighted much, much higher than their official credit score.
That dynamic scoring must make a huge difference in opening up access. But doesn't it raise massive privacy flags? I mean, if every digital interaction becomes part of my loan application.
That is the essential tension. It really is. These modern models, they often outperform traditional scores, especially for people with thin files, because they offer a more complete real-time picture of your current financial health.
Okay.
But yes, the regulatory challenge, which we see playing out globally, is maintaining user privacy while maximizing the accuracy these models rely on. The consumer has to trust that the platform isn't just selling their spending habits.
And if we look ahead, open banking is just poised to turbocharge this even further.
Massively. As open banking protocols expand globally, lenders get instant access to verified transaction data directly from bank accounts, with user permission, of course.
Of course.
This allows for just unparalleled precision in assessing true affordability and cash flow behavior. It makes the underwriting process faster and, in theory, fairer. It relies on facts, not just projections.
Okay, now let's zoom out. Our sources making clear that P2P models are highly adaptive. They look vastly different depending on the country. It's not a single monolith.
Oh, the differences are profound. Let's start the U.S. model. So platforms like LendingClub and Prosper, as we said, they quickly became institutional marketplaces.
The U.S. market seems to be characterized by scale and serious compliance demands.
Exactly. To handle that massive institutional capital, the U.S. platforms had to become incredibly sophisticated in compliance and transparency. They often securitize these loans.
Meaning they package them up to be sold as bonds.
Yes, to hedge funds and banks. This requires regulatory compliance that looks a lot closer to investment banking than it does to the original, grassroots P2P concept. Their focus is consumer credit, auto refinancing, all at massive scale, fueled by Wall Street.
Now contrast that with the UK story. Platforms like Zopa and Funding Circle.
The UK story is really defined by governance. Regulators there were very proactive. They introduced specific rules for platform risk management, mandatory capital buffers, strong disclosure standards, almost from the start.
So less Wild West and more focus on sustainable growth.
Yes, exactly. A much more disciplined market focused heavily on consumer protection. The UK platforms also pioneered the practical application of open banking data, particularly in SME finance.
For small businesses.
For a small business applying for working capital, the platform can instantly verify their cash flow, their invoice history. And that reduces fraud and default risk while giving much faster decisions than a high street bank ever could.
Okay, so now we have to turn to the critical cautionary tale,
Yeah.
which I think offers the most important lesson in governance and risk oversight. China.
Yes.
This market went from zero to the largest in the world and then just collapsed dramatically.
If we connect this to the bigger picture, China is the case study in what happens when regulatory paralysis meets explosive, unchecked demand. The growth was just unbelievable. At its peak, China had thousands of platforms.
Thousands.
The problem was a total lack of capital requirements, the ease of launching a platform, and just an absence of effective oversight.
What specifically caused the catastrophe? Was it just high default rates?
It was systemic fraud and a complete misalignment of incentives. Many platforms were essentially Ponzi schemes. They were using new investor money to pay off old returns, diverting funds. It was a mess.
And there was widespread borrower over-indebtedness.
Huge amounts of it, all because of easy credit. So when the default started, the dominoes just fell, one after another, very rapidly.
And the intervention?
It was brutal and necessary. Regulators aggressively shut down thousands of platforms, initiated criminal proceedings. It was a massive restructuring that wiped out the original model.
But the innovation wasn't lost.
No, it just shifted. It moved into regulated digital lending supported by banks and massive AI-powered credit analytics firms. The lesson really is that technology without governance is just organized chaos.
That contrast, U.S. stability, U.K. governance, and China's collapse, really grounds our understanding of the risks. So let's shift to where P2P and digital lending are filling vital credit gaps, the global south.
India is a phenomenal example of this digital transformation. They saw the potential early on, and the Reserve Bank of India created a dedicated, pretty stringent regulatory framework. Platforms have to be licensed and transparent.
What credit gaps are they filling there specifically?
They are reaching micro-entrepreneurs, freelancers, and small businesses that simply can't get loans from the large state-owned banks.
People outside the formal system.
Exactly. Platforms like Faircent use extensive alternative data. I'm talking employment indicators, digital behavioral patterns, detailed bank statement analysis to create credit profiles for millions of people who were previously invisible to the credit system.
And that necessity is even clearer in regions with low formal banking penetration, like in Africa.
Absolutely. Across Kenya and Nigeria, the P2P approach is inseparable from the mobile money ecosystem. The phone is the bank.
Right.
And lending decisions there rely so heavily on alternate data, like mobile money usage patterns, airtime purchases, transaction flows, even repayment behavior from tiny digital loans.
So their entire credit history is built on how consistently they pay for utilities or top up their phone.
Precisely. It's necessity driving innovation. The goal is rapid financial inclusion. But this requires an incredibly careful balancing act. The regulatory challenge is making sure this fast access to credit doesn't lead to over-indebtedness for vulnerable populations. That's a key risk.
And what about Latin America? Brazil, Mexico, Colombia? What's the defining characteristic there?
In Latin America, P2P and marketplace lending often fills the gap created by frankly, ridiculously high credit card interest rates. So platforms offer a crucial alternative for consumer credit and SME financing. They use sophisticated behavioral analytics and digital onboarding to reach underserved borrowers. They're often analyzing business sales activity, inventory cycles, even social connections to deliver working capital loans more efficiently than local banks that are just burdened by these legacy systems.
And we should briefly mention Singapore, which offers a great model of a controlled, purpose-driven P2P environment.
That's right. Singapore, with its very controlled financial environment, focuses heavily on SME financing. They maintain strict financial discipline using cash flow analytics, invoice histories, and they make sure that the P2P sector is targeted toward filling specific economic needs, not just mass consumer lending.
Okay, this entire deep dive just shows how dynamic and adaptive this model is. We've covered the history, the mechanics, the global landscape. Let's look at the future. What does the source material suggest is next for marketplace lending?
The direction is pretty clear. Increased efficiency, technological convergence, and high institutional dominance. We expect these hybrid models to fully cement their control.
Meaning institutional capital will dominate funding.
It will. But platforms will likely create highly diversified, regulated investment products that allow retail participation without the direct, unstable risk of funding single loans.
More stability, less risk of the system crashing because of a panic on Twitter.
Exactly. On the tech side, the convergence of AI, open banking, and digital identity will lead to near instantaneous loan decisions and near perfect risk pricing, assuming the data inputs are accurate. The friction is being eliminated.
And speed remains critical in finance.
Real-time payments are becoming the standard globally. This allows for immediate disbursement of funds and faster, maybe even daily repayment cycles.
Which creates more flexibility.
So much more. Platforms can offer highly customized short-term lending products that just weren't possible 5 years ago.
And finally, the really cutting-edge concept that our sources hint at. The potential for blockchain-based instruments to change the investment side.
This is fascinating. You need to keep an eye on tokenized lending instruments. Think of it this way. Instead of an institution buying an entire loan portfolio, the loan's income stream is fractionalized or tokenized into secure digital assets.
So you're saying I could own a tiny digital piece of the income stream from 100 small business loans across 3 different countries?
Precisely. It further diversifies risk. It opens up loan investment to a wider range of investors globally, and it uses blockchain technology to provide instantaneous settlement and greater transparency. It's the ultimate convergence of FinTech and decentralized concepts.
This has been a critical deep dive.
Yeah.
We've seen P2P evolve from this idealistic concept into a globally dominant financial service powered by data and shaped by regulation.
But it really has.
The core takeaway, for me, is that P2P demonstrates how technology can just violently disrupt old systems, reduce credit barriers, and rapidly expand access to borrowers who are traditionally ignored by incumbent banks.
I agree. P2P and marketplace lending are now profoundly integrated into the broader financial ecosystem. They are more regulated, more institutionalized, and just infinitely more data-driven than they were a decade ago.
Which brings us to a final thought.
It does, and it raises an important question for you, the listener, to consider. We've established that modern P2P scoring relies so heavily on alternative data. Your spending patterns, your mobile usage, your digital interactions.
All of it.
All of it. So, given the increasing accuracy these models provide, how should governments and consumers think about balancing the immense financial benefit of accurate underwriting against the necessary expectation of user privacy in a world defined by open banking? That trade-off, that is the central challenge for modern financial services.
That's certainly something to mull over as you see your digital footprint grow.
Yeah.
Thank you for joining us for this deep dive into the evolution of peer-to-peer lending.
Essential knowledge for anyone tracking the future of credit.
We'll catch you on the next deep dive.